right, the economic calendar is ticking down. It's the second week of the month. The tension is just palpable on trading desks everywhere, and screens are flashing red and green. Welcome to this explainer. We're going to jump right in today, zero fluff, because we are looking at the absolute pulse of market volatility.
Look at that time right there, 8:29 and 59 seconds a.m. Right now, in this exact frozen second, the entire market is holding its collective breath. You've got bids and asks stacked up. Algorithms are totally primed. In just this one solitary tick of the clock, literally millions upon millions of dollars are poised to completely change hands across the global Forex market.
And then, boom, 8:30 a.m. The CPI report drops and the charts just absolutely explode. The immediate ferocity of this reaction is wild. Now, most casual retail observers, they're going to read about what just happened in an article like 5 minutes from now. But the headlines always come late. The market's already made its move. The pros, they are watching what happens in those very first 5 seconds, because that is where the real story begins, way before a single word of news is even written.
Okay, let's dive into this. Section 1, the 8:30 market explosion, a tick-by-tick autopsy.
So what's actually causing all this chaos? Well, it's the Consumer Price Index, or CPI. As you know, it's the ultimate benchmark tracking inflation, basically measuring the average change in prices for a basket of consumer goods over time. But why does this one specific metric trigger such massive, immediate volatility across the globe? Simple. Inflation dictates central bank policy, that policy dictates interest rates, and well, interest rates dictate currency valuation. It's basically the financial market's equivalent of pulling the fire alarm.
Let's walk through this autopsy, looking at just the first 60 seconds. At exactly 8:30 a.m., the number hits the wire, and humans aren't even the first ones reacting. High-frequency algorithms instantly ingest that data, executing trades in literal milliseconds. By 8:30 and 3 seconds, just 3 seconds later, you'll see the US dollar and Treasury yields spike aggressively as those algos sweep the order book. Then by 8:30 and 10 seconds, major pairs like the euro-dollar start violently reversing. Liquidity suddenly gets razor-thin, and spreads widen out dramatically as market makers just scramble to manage their risk. In 10 seconds flat, the whole landscape of the market is completely redrawn.
Moving on to Section 2, what actually moves markets, beyond the headline.
I'm going to slow the pacing down for just a second here, because we really need to understand that the market isn't just blindly reacting to a single, flat number. And this brilliantly illustrates the nuance professionals are looking for by splitting the data. So, you've got headline CPI, that's your overall inflation number blasted across all the mainstream TV channels. But then you have core CPI, which strips out those really volatile food and energy sectors. Core CPI is what the pros, and more importantly, the Federal Reserve are actually watching. You see, energy prices can swing wildly from month to month just based on geopolitics, which totally masks the real underlying economic trend. If headline CPI is up but core CPI is down, man, that market reaction is going to be incredibly complex. Traders who only skim the headline, they're getting caught completely off guard.
Which brings us to the holy trinity of economic data releases: actual, forecast, and previous. You know, markets don't really care about the actual number in a vacuum. What they care about is how that actual number stacks up against the forecast, what the economists were expecting, and the previous month's data. Think about it. If inflation comes in high, but it's actually slightly lower than the forecast, the market might rally, even though inflation technically went up. These financial markets are forward-looking pricing mechanisms. They swing violently simply because expectations shifted, not just because the raw inflation number changed.
All right, Section 3, why headlines are too late, the market disconnect.
Let's compare these two worlds real quick, because there is this massive fundamental disconnect between what mainstream financial news reports and what the actual market is doing under the hood. On one side, you've got standard financial news articles. They're inherently simplified for a mass audience, right? And by the time they're actually written, edited, and published, they're at least 5 minutes late to the party. But on the other side, professional trading desks. They are absolutely not waiting around for a journalist to summarize the data. They're reacting instantly by watching the bond markets. Honestly, the narrative the news pushes is usually just a lagging indicator of a move that institutional money has already capitalized on and exited.
So while the retail crowd is sitting there aggressively refreshing a news website, the pros are glued to totally different metrics. They're watching Treasury yields. They are recalculating Fed expectations and rate probabilities in real time. They are watching the US dollar index tick by tick. The reality here is that the bond market usually leads the charge, currencies respond immediately to that bond market hue, and those news websites, they're just left scrambling in the dust trying to explain what happened in hindsight. This brings us to Section 4, the Forex broker opportunity. Educate your audience.
Zooming all the way out from the micromechanics of the order book for a second, so the crucial point is this. Major macroeconomic events, like a huge CPI release, create an enormous, almost insatiable demand for trustworthy info. Now, a lot of brokers just repost the news, right? They tweet the CPI number just like everybody else, but let's be honest, that adds zero value. The true opportunity is in actually explaining the volatility. Traders don't need a broker to tell them inflation ticked up 0.2%. They need a broker to explain exactly why the euro-dollar just dropped 50 pips in 3 seconds despite that number.
So how do we build this into an actionable roadmap for brokerages? Step 1. Publish rapid, clear explainers that break down the why behind a move. Step 2. Create deep dive market commentary that analyzes that core versus headline nuance we talked about. Step 3. Release educational videos walking traders right through the actual chart action. And finally, Step 4. Issue timely PR. Listen, PR isn't just for announcing you hired a new executive, it's about actively inserting your brand into the biggest market conversations as a trusted authority. By hitting these steps, brokers can completely transform from just being mere trading terminals into indispensable educational partners.
Which really just leads us to this incredibly powerful takeaway. Markets move in seconds. Trust is built over years. The brokers who step up and actually educate their clients during those terrifying moments of high volatility, those are the ones forging unbreakable loyalty. When a trader is sitting there totally confused by a wild market swing, the brand that gives them clarity is the exact brand they're going to return to month after month, year after year.
So I want to leave you with this final thought to chew on. How will your brokers stand out during the next major macro event? Are you just going to be another voice echoing the news 5 minutes late, or are you going to be the authority that actually helps traders understand it? Every single economic release is a huge opportunity to strengthen your credibility. Providing that clarity is exactly what builds long-term visibility. And honestly, tools like Forex PR wire packages are designed specifically to help brokers facilitate these critical conversations. If you found this explainer valuable, make sure to subscribe for more deep dive market analysis and marketing strategies. We'll see you for the next big release.